Welcome to Lesson 4. This investment mistake I'm going to talk to you about is called timing the market. So, first, let me tell you how you can become a millionaire by investing. It's pretty simple, but don't share this secret formula with anyone else. Okay, here's what you do. So our goal is to end up with $1 million. So what you want to do is this. What you want to do is start with $1 billion, and then you time the market and you'll get down to $1 million. Honestly, this is the proven method to become a millionaire. Start with $1 billion, time the market, and you end up with $1 million. But let's look at some real world data. This little bit was written for Charles Schwab, and I want to share it with you. Imagine for a moment that you've just received a year-end bonus or income tax refund. You're not sure whether to invest now or to wait. After all, the market recently hit an all-time high. So now imagine that you face this kind of decision every single year. Do you invest? Do you not? Sometimes it's in an up market, sometimes it's in a down market. Is there a good rule of thumb to follow? Because timing the market perfectly is, well, about as likely as winning the lottery. The best strategy for most of us mere mortals without a crystal ball is not to try to time the market at all. But don't take my word for it. Consider Schwab's research on the performance of 5 hypothetical long-term investors following very different investment strategies. So each of them received $2,000 at the beginning of every year for the last 20 years, ending in 2012, and left the money in the market. So let's find out how these 5 hypothetical investors would have done. Peter Perfect was a perfect market timer. He had incredible skill, or maybe luck, and was able to place his $2,000 into the market every year at the lowest monthly close. He continued to time his investments perfectly every year through 2012. Ashley Action took a simple, consistent approach. Each year, once she received her cash, she invested it. Her $2,000 went into the market at the earliest possible moment. Matthew Monthly divided his annual $2,000 allotment into 12 equal portions, which he invested at the beginning of each month. Rosie Rotten had incredibly poor timing, or perhaps just terribly bad luck. She invested her $2,000 each year at the market's peak every single year for 20 years. Larry Linger left his money in cash investments using treasury bills as a proxy every year and never got around to investing in stocks at all. He was always convinced that the stock market was going to be lower and therefore better opportunities to invest his money at a later point, and were always just around the corner. So let's look at how each of these 5 hypothetical investors would have done. So what do you notice? Well, the perfect market timer, the investor that bought precisely at the very best times over the last 20 years, obviously did the best. But look at the others. Other than the guy who didn't invest at all, they all did pretty well. The takeaway is that you do not need to be extraordinary. You don't need a crystal ball to get a good investment return. Remember, it's not about timing the market, it's time in the market. Okay, pop quiz for you. Who said this? I'm no good on what's going on in the markets. I have no idea what will happen tomorrow or next week. They get very volatile like this, and other times they put you to sleep. But the important thing is where they're going in 5 or 10 years. And I'm confident they'll be considerably higher in 10 years. And I really have no idea where they'll be in 10 days or 10 months. So who said that? Find out the answer next time, and something else that this famous person said that can make a huge difference for you as an investor.